Welcome to the MUFG Global Markets Asia podcast. I'm Lloyd Chan, Senior Currency Analyst with the MUFG Global Markets Asia Research Team. The following podcast is for informational purposes only. It is intended for professional investors and eligible counterparties and not for retail clients. Any content should not be regarded as an offer to conduct investment businesses or investment recommendations. Today, we are assessing our outlook for the Indonesian Rupiah, a currency that is currently navigating a complex confluence of political uncertainty, mixed macroeconomic fundamentals, and policy responses. Recent street protests in Indonesia have been triggered by a proposed increase in lawmakers' housing allowances. This has introduced some political risk premium into the Rupiah. While the Rupiah still offers a relatively high yield, it is not enough to compensate for the rise in political uncertainty. Markets have reacted with the Rupiah weakening towards the 16,500 level against the US dollar, implying that markets are pricing in about 1.5% of additional risk premium based on our estimates. However, with recent heightened law enforcement helping to restore some normalcy for now, markets are starting to stabilize, with the Rupiah hovering at around the 16,400 level against the US dollar. Assuming the political situation doesn't escalate further from here, we maintain our GDP growth forecast of 4.8% for both 2025 and 2026. And we expect the Rupiah to strengthen to 16,140 against the US dollar by year end, supported by strong policy buffers and a softer dollar backdrop. Bank Indonesia has stepped in with FX intervention, helping to anchor market confidence and containing currency volatility. Complementing central bank efforts, the government has also announced a rollback of the proposed increase in lawmakers' housing allowances, an apparent response to the protests. This reflects a familiar pattern in Indonesia's political landscape, where public demonstrations tend to prompt policy reversals. Despite the social unrest, foreign portfolio inflows have remained resilient. Net equity outflows were modest, while bond inflows persist, suggesting continued investor confidence in the fixed income space. Indonesia's 5-year credit default swaps also rose slightly, but remain historically low. This indicates that markets have not priced in significant deterioration in sovereign credit risk. If the protest is managed effectively and proves short-lived, the economic impact from the protests could be contained, paving the way for markets to unwind the recent higher political risk premium being priced into the Rupiah. Macroeconomic conditions are mixed for now though. Indonesia's Q2 GDP growth accelerated to 5.1% year-on-year, driven by resilient private consumption, investment, and exports. Manufacturing PMI also returned to expansion territory in August, while the trade surplus widened to $4.2 billion in July, offering a buffer for the Rupiah. However, not all economic indicators are upbeat. Consumer confidence has declined. Motor vehicle sales down 10% year-on-year in the first 7 months of 2025, and credit growth has also moderated, signaling a softer domestic demand outlook ahead. Encouragingly, policymakers have signaled their intention to support growth and the Rupiah. Budget disbursement has been quite slow in the first half of this year, leaving room for increased fiscal spending in the coming months. The government now projects a wider deficit of 2.78% of GDP for 2025, up from 2.5% previously. The larger deficit projection will still be below the 3% constitutional deficit limit, so we don't expect markets to price in a larger sovereign credit risk. Looking ahead to 2026, the government is targeting a narrower deficit of 2.48% of GDP. But we think fiscal consolidation will be delayed due to domestic and external headwinds. Instead, we forecast a wider fiscal deficit of 2.9% of GDP in 2026, reflecting more cautious revenue and growth assumptions compared to the budget. This would imply that the fiscal impulse will remain modestly positive next year. Indeed, the government has listed several key spending priorities in the 2026 budget. These priorities include the free nutritious meal program, with 335 trillion rupiah being allocated for 2026, up sharply from the 70 trillion rupiah deployed this year and representing nearly 9% of the budget. Other key priorities include strengthening food and energy security, education, and healthcare. So about half of the budget is allocated for these priorities. In addition, the government plans to expand the role of Danantara, its new sovereign wealth fund, as an engine of growth. The government also aims to accelerate $38 billion of various mineral downstreaming projects, which could bode well for local mining companies. A revival of bank credit growth will also be crucial to sustaining growth momentum in Indonesia. Monetary policy conditions will thus need to be more accommodative to help lower bank lending rates further. However, we expect further monetary policy easing will need to wait till the fourth quarter, given the narrowing rate differential with the US, which is now just 75 basis points. That said, other policy measures are helping to ease market liquidity conditions. Bank Indonesia has reduced its SRBI outstanding, and SRBI yields have also declined, encouraging banks to shift away from holding SRBI and towards credit expansion. This easing in liquidity, potential rate cuts ahead, and larger fiscal support should all help sustain domestic demand and cushion the rupiah. So what's the bottom line? Political uncertainty has indeed introduced near-term weakness in the rupiah. However, we think the rupiah outlook will remain anchored by policy buffers, which include strong macro policy support and Bank Indonesia's ongoing currency intervention efforts. We therefore remain cautiously optimistic with a year-end target of 16,140 for the rupiah against the US dollar. Thank you for listening to the MUFG Global Markets Asia podcast. Read, review, and subscribe on Apple, Spotify, or wherever you subscribe to your podcast. Contact your MUFG sales representative for more information. Check back again for more insights from the Global Markets Research team.